Welcome everyone to the 5th annual and first ever virtual Keenan Institute Frontiers of Entrepreneurship Conference. We're thrilled to have you with us, even without our usual draw of a winter hiatus down at the Breakers. I'm Greg Brown. I'm professor of finance at UNC Kenan Flagler Business School and executive director of the Frank Hawkins Kenan Institute of Private Enterprise. The Kenan Institute is proud to host this conference in partnership with UNC's Entrepreneurship Center, which is led by Vicki Gibbs. You'll be hearing from Vicki later in the conference. For those of you unfamiliar with the Kenan Institute and our work, we're a nonprofit, nonpartisan business think tank affiliated with UNC's Kenan Flagler Business School. Our core belief is that private enterprise is the cornerstone of a prosperous and free society, and we seek to foster the entrepreneurial spirit to stimulate economic prosperity and improve the lives of people around the world. We do this by leveraging cutting-edge research to develop and promote innovative market-based solutions to vital economic issues. And of course, following this past year's pandemic and the economic fallout, as well as the renewed calls for global and racial equity and justice, it's really my hope that this year's conference offers us all inspiration and insights for the ways in which entrepreneurship might drive our economy and our society forward. Before we kick things off, I want to thank those who have helped us get here. First, this conference couldn't happen without the amazing staff of the Kenan Institute, especially Sydney Bannerman, who is our events manager and tireless architect of this convening, but also Mackenzie Babb, our director of external affairs, and her team, Ashley Brown, our director of research services, and her team, and David Knowles, our director of business development, and his team. I also want to recognize our partner schools in this endeavor, of course, UNC Kenan Flagler, but also Duke's Innovation and Entrepreneurship, the Stanford Technology Ventures Program, UCLA Anderson School of Management, the University of Chicago Polsky Center for Entrepreneurship and Innovation, the Wharton School, and the Yale School of Management. So finally, we're tremendously thankful for our sponsors, Ripple, the Small Business Investor Alliance, and VentureWell. As you know, in addition to kicking off our conference today, we're also releasing our 2021 Trends in Entrepreneurship report. This year's report maps really closely into the conference topics of capital access disparities, creating ecosystems where diverse entrepreneurs thrive, the burgeoning of entrepreneurship in healthcare, as well as entrepreneurial teams and talent. Creating the 2021 report has taken a lot of effort by the editorial team and staff. It was led by senior editors Sekou Burmis, Maka Mouine, and David Robinson, managing editors Ashley Brown and Vicki Gibbs, and also our associate editors Chris Bingham, Tom Byers, Chuck Easley, Kathy Eisenhart, Yale Huckberg, David Sue, Steve Kaplan, and Olive Sorensen. So we also benefited from the research support from the team here at the Kenan Institute, Sarah Kenyon, Bipul Katka, Juan Leanne, and Cecilia Poston, and copy edit and design support from Sue DiMaggio, Jack Walker, and Mackenzie Babb. The report has a ton of valuable information in it, some data, some never before seen data. So really encourage you to download the report and take a close look at it. The data partners for the report were Omni, the National Venture Capital Association, and the U.S. Securities and Exchange Commission Office of the Advocate for Small Business Capital Formation. So you'll be hearing more about the report shortly. You can now download the full report or by section that corresponds with the conference. As many of you know, we launched the Trends report last year at the conference, really as a way of informing the content in the discussion sessions, and as well as staying up to date and connected through the year with quarterly special topics issues. This year, you're going to see an even tighter connection between the Trends report and our conference sessions. Going forward, we're going to continue to build on this format by really constructing the conference program around trends that are submitted by our community of academic, practitioner, and policy experts. We want to help you share your insights on current topics that are important to entrepreneurship and innovation. I'm excited to announce that we're planning to be back at the Breakers next year on January 27th and 28th, so mark your calendars. We're already preparing for next year's conference, and we invite you to send us your trends based on your research. People ask us all the time, how can they be assured of attending the conference? One great way is to submit a trend and have that accepted as part of the report. We'll be providing a complimentary registration for each accepted trend, as well as for the first time next year awarding prizes for the best submissions. So we'll be providing detailed information on submission in the coming weeks. So before I introduce our first speaker, a few housekeeping details. We have an excellent program lined up for the next 2 days, beginning with this morning session on capital access disparities. After this session, we'll pause for a brief break, followed by our second session on diverse entrepreneurial ecosystems. Tomorrow morning, we'll resume at 11 o'clock Eastern time for sessions on health analytics and entrepreneurship, as well as entrepreneurial teams and talent. Also, please note that we'll be recording the session, so you can access that content after the conference on the Kenan Institute website, kenaninstitute.unc.edu/KIFE/2021. And finally, you can submit any questions that you have during the panel discussions using the Q&A button at the bottom of your screen. We'll work to answer as many of them as we can. And finally, we'll be gathering for informal networking sessions to continue the conversation from these panels today and tomorrow at 2 p.m. So be on the lookout for that if you're interested in having a live discussion with folks. Of course, you're always able to join the conversation on Twitter using the hashtag KIFE2021. And with that backdrop, I'm excited to turn things over to my friend and colleague, Olav Sorensen, to kick us off with an overview of our first trend and discussion topic, capital access disparities. Olav.
Sorry, let me just share my slides here. All right, hopefully everyone can see that now. All right, so thank you so much for the introduction, Greg. I'm looking forward to being back at the Breakers next year, but I think that we have a great set of participants and an interesting agenda for this year, so I'm looking forward to the conference. My role here is to really provide a little bit of data from the Trends in Entrepreneurship report that's relevant to this first session.
Olaf, we're seeing your notes, not your slides. So you've done something wrong with the sharing.
Sorry, thank you.
It wouldn't be an online conference if there
exactly.
was something wrong with
it. Didn't mess it up. Does it work now?
That's better.
All right, thank you. So, once again, I'd like to give you a bit of information from the Trends in Entrepreneurship report. If you read last year's report, you'll realize that what I've got here is a very small excerpt from the report. And in fact, this year's report has more than 60 plus pages just on the funding. So I'm just going to touch on some of the kind of main themes maybe in the report. So if we were sort of thinking about summarizing what we're seeing on the funding side, a lot of what we've seen in the press has really been about what has been called sometimes a K-shaped recovery. And we certainly see that playing out in public equities. The prices of tech companies have been soaring. Meanwhile, a lot of stocks related to more mainstream businesses have been either languishing or even declining over time. And in fact, what we're seeing in kind of small businesses and startups very much reflects, I would say, that same type of divergence. And so what I want to present here, I'm really thinking of in terms of, kind of what's good, the bad, and the ugly. And I'm going to start with kind of what's I think is the upside, maybe the kind of bright light for the potential future, and then maybe become a little bit more pessimistic. So in terms of what's good, I think one of the really promising trends is looking at business formation rates. So this chart here is showing what has been the rate of business formation over the last roughly kind of 10 years. Actually, the horizontal axis on this is wrong. It should run from 2004 to 2020. I'm not sure why it has reformatted to this. But basically what we're seeing is the green here is showing the startup formation rate for sort of all startups. And you can think about a lot of the green are, kind of local services. What I think is even more interesting here is to look at the orange part of the chart. These are high potential businesses, ones that are likely to start having employees, not simply be self-employment or some sort of contractor. And what we're seeing is that there's a really market increase, although it's not as obvious from the vertical axis. There's a really market increase, not just in people working for themselves, but also in people starting businesses that are likely to employ others. And, that I think bodes well for the future in the sense that these are likely to be the medium and even large businesses, maybe the Facebooks and Teslas of tomorrow. We also see a lot of room for optimism if we look at the venture capital side. So the venture capital is really, capturing probably the top, half of 1% of the highest potential businesses that are out there. And if we look at venture capital continues almost as though nothing has happened for the last year. If we looked at the number of deals or the number of companies being funded, we're continuing to see the same type of high rate of activity that we've seen for the last few years. In fact, funding dollars overall for 2020 even hit a new high. So from the venture capital world, we're seeing very much what we see in the public equity world, where there seems to be a lot of enthusiasm and tech businesses have been able to continue almost unimpeded by the crisis. And part of that is probably the fact that, a lot of these businesses had processes that were heavily based on online interaction already. And so it was not that difficult for them to kind of continue to produce, continue to develop their businesses by moving virtually, even if no one was coming into the office. Many of them were even helped as people were turning to these as substitutes for either in-person interaction or in-person shopping. But of course, that's the good side, and the downside, or the kind of the nature of the K-shaped recovery, is that there's also a number of businesses that are hurting. And so the bad here, I would say, is really thinking about Main Street. So we look at the Main Street businesses. This chart is focusing just on the last roughly 15 months and what's happened to the sales of those Main Street businesses over those 15 months. And what you see is that over essentially this entire time, Main Street businesses have been at least kind of 20 to 30% off of their normal sales levels. Interestingly, there's even disparities among these Main Street businesses in terms of where we're seeing the largest reductions in sales. So the green line on this chart is what the sales reductions have been in zip codes that have the lowest average incomes. Whereas the red line is what we're seeing for sales in zip codes with the highest average household incomes. And perhaps surprisingly, we're actually seeing that there's lower sales in the high income zip codes, or higher loss of sales in the high income zip codes than we're seeing in the lower income zip codes. It's probably a combination of factors that account for this. One is certainly that there's a little bit different mix of businesses. So more of the businesses that you see in high income neighborhoods tend to be businesses that are, let's say, less essential, easier services to forego. And so that has hurt those businesses more. There may also be some differences in the propensity for substitution. So higher income individuals may be more likely to substitute Amazon purchases, for example, than going to a store than you see in lower income neighborhoods. Now, as bad as all of this seems, it could have been worse. These are sales figures. These are not business closures. And one of the things that I think has, and I think this will come out in the panel, that has probably reduced the number of business closures that we've seen is the Paycheck Protection Plan, which has actually allowed small businesses to get access to loans to help them maintain their businesses and employment. Now, This has certainly helped. And so we haven't seen the same number of closures that we probably would have seen in its absence. But I think one of the things that is perhaps worrisome here is, what happens when PPP ends? If you look at the, kind of the far right figure, the circle graph there, in the notes below that, it's talking about the proportion of businesses that are actually worried about having to close permanently. And 58% of small business owners said that they were worried about having to close permanently in the near future. Just to kind of, it's hard to kind of think about what that stat means, but imagine walking down your local downtown and having every other storefront, whether it's a shop or a restaurant, be it empty. So, I think it's likely that we probably haven't seen the full extent of what the bad side in some sense of the last year has been. And that brings me to the last point, which is what I sort of think of as, I'm labeling the ugly. So, there's not just disparities between Sand Hill Road, if we're thinking about kind of high tech, and Main Street, or maybe if we're really going to be specific to Palo Alto, to University Avenue, since that's really the main street in Palo Alto. But there's also some real disparities within these groups. And part of the problem with, I think, what's been happening over the last year is that many of these existing disparities, the gaps are actually widening. So some of the stats that are relevant to this in the report, showing some interesting information, again, from the Office of Advocacy for Small Business Capital Formation. If we look at, sort of exactly which businesses are closing, we've seen a lot of closures overall. So overall, they're showing 22% of small businesses closing over the last year. Perhaps worryingly, the closures have been even larger among underrepresented groups. So 26% of businesses owned by women closed over the last year, and a somewhat staggering 41% of businesses owned by African Americans have closed over that same period. So, we already had a fairly wide wealth gap between African Americans and others, and that wealth gap, if anything, is likely to increase if we think that kind of small businesses are one road to narrowing the gap. And these disparities have really been increasing almost across the board in different ways. So we see it in the venture capital data. One of the things that, of course, has been a topic in previous discussions of the conference is that women receive much less venture capital funding than maybe than you would expect, certainly as a percentage of the population, but also probably as a percentage of even of high-tech entrepreneurs. There's been a lot of progress over the last few years, but if we look at the last year, we're actually now again seeing a widening of the gap with the number of, or the value of deals for businesses that are founded by women declining by 31%. So almost twice the decline seen overall in the terms of the number of startups. We're also seeing some disparities in the Main Street. PPE, one of the issues that I think will come out in the conversation is that the actual distribution of PPE funds has been mediated by banks, and there seems to have been some disparities in the allocation of that. One of these that I think is particularly interesting, but also discouraging is this Atkins et al. Study, which is mentioned, which found that Black-owned businesses received 50% smaller loans from PPP than similar, let's say, white-owned businesses. And one of the things that makes that, I think, particularly sort of important is that, they were very careful to try to look at observationally equivalent businesses. So the same types of businesses with, kind of similar types of, you might think, prospects, and yet the African-American owned businesses are receiving substantially smaller loans. So this is really just a, a very, kind of a quick, in some sense, teaser of what the report has for statistics. I do think there's hope for the future. And in some sense, the business formation rate, I think particularly the formation of these high propensity, high growth businesses means that we're likely to see some really strong future companies emerge from this period. But at the same time, we probably still haven't seen the full extent of damage to some of the more mainstream small businesses and startups out there. And we're again seeing increasing issues of inequality. So with that, I would encourage you all to download and read the full version of the report, but I will turn it back to Greg and our panel.
Thank you so much, all. That was great. And we're now going to move into the panel discussion of this topic. I'd like to introduce David Robinson, who's going to moderate that conversation. David is the James and Gail Vander Weed Professor of Finance at Duke University's Fuqua School of Business. He's also a research associate at the National Bureau of Economic Research and leads the entrepreneurship efforts for the National Bureau of Economic Research. He's definitely an internationally recognized expert in the field of private equity, venture capital, and entrepreneurial finance, and the perfect person to lead this, this discussion. Turn it over to you now, David.
Thank you, Greg. Thank you for that introduction. I'm really happy to be here, and I'm really excited about this panel and the chance to hear from the three experts that we have. Olaf, thanks for that introduction. I think you did a wonderful job of teeing up a lot of the themes that we want to try to explore in our panel discussion today, which is entitled Capital Access Disparities. And just to tie back to what Olaf was saying, we're really here to discuss, in some sense, I'll borrow Olaf's language, the difference between Main Street and Sand Hill Road, or the difference between Main Street and University Avenue. And to do that, we've got three great panelists. I'm very pleased to, let me just introduce them quickly. I'm very pleased to share the panel with Yael Hochberg, who is a professor at Rice University and the person in charge of the Entrepreneurship Center at Rice. We're very happy to also have Steve Kaplan from the University of Chicago, also the faculty director of the Polsky Center for Entrepreneurship there. And then we also are very happy to be joined by Sandra Moore, who is managing director and chief impact officer at Advantage Capital. Before I dive into the questions, let me just set some ground rules. First of all, I'm really hoping to just be a funnel between the Q&A coming in from our huge number of participants we have on the call and these three experts. So I'm going to direct the conversation, but I'm going to be paying close attention to the Q&A window. If you have questions that you'd like us to discuss, by all means, type them in. And we've already gotten a great question from Mike Nerona that I'm going to try to pick up with shortly. Just type them in the Q&A window and I will do my very best to incorporate them into the conversation. With that, let me just jump right in. And Sandra, I think I'd like to start with you, if you don't mind, because you're right there on the ground at impact level, dealing with companies who are trying to navigate their way through everything that we've been through over the last year. And so, let me go back to Olaf's points about the payroll protection plan, and maybe we can start there. What are your views about how effective this was in the segment of the market that you've seen? How do you see the portfolio companies you're dealing with? How have they responded to the crisis, and kind of what do you think we should do differently, and what lessons can we take away from what you're seeing?
Well, David, first of all, thanks for the introduction, and I'm very, very happy to be here. Let's do a sound check, make certain you're hearing me okay. And to answer your question, I'm excited to answer it, but let me contextualize just a little bit so that our audience understands the vantage point from which I answer. And I am Chief Impact Officer at Advantage Capital. We're a venture capital firm, small business lender, and impact investor focused on growth. So we We've been around a very long time. We've got, 3.6 billion in assets under management at any moment, and about 200 companies, 230 that we're working with, 800 over the last 30 years, and they're small businesses. They are the quintessential companies that needed the support of PPP. So we saw, and we dug in with our companies and did everything that we could to make certain that they had access, because as is pointed out in some of the early framing data, access was not equal and it was not easy. So that as an investor, we saw that as a real opportunity to step in and support, but it also gave us a very good view. And there was an upside and there was a downside. If we just looked at our own portfolio, what we can tell you is that PPP really put a floor underneath our portfolio companies and allowed all of them to hold on. And we were very, very pleased by that. We did not have a need to make any significant economic adjustments in order to help those companies. PPP did that. We did have to make some concessions on governance, and we believe that was probably an unintended consequence in the development of PPP. Some of the governance concerns that they required be mitigated in order for companies to qualify for PPP. We did that, and so again, really a floor and held our companies, and we found that to be very, very, very important. Now, the bigger question is looking forward, what is it going to take and what are we going to need to do in order to make certain that our companies can be held, many are recovering, and now we need them to grow. And that is the question, and many of my fellow panelists will help to opine on that. Let me just dig in on one little thing that I want you to pay attention to when you think about this growth after recovery and what kind of policy we are going to need in order to help that happen. Policies that will reduce disparity, important disparities. I'm going to look at one little piece. Let's talk about wages. Big disparity there across America, even and exacerbated in small businesses because they frequently may have the will to want to pay good wages and have good benefits, and they don't have the financial structuring to do so. Well, in this pandemic, what we've seen is that there, even for those companies with the will to support wage progression, wage growth year over year, advancement in wages for their workers, the pandemic threw a big wrench in that and it stalled it. So PPP allowed them to keep their employees on and keep them where they were, a very good thing. But how are they going to cover the ground that was lost in the last year and the wage ground that will be continually lost over the next year as we continue to recover? And what kind of policies can we put in place to support that? Or what kind of policies can we put in place for investors like Advantage to be able to support companies to get back into that tranche of wage progression being part of what the business looks at? It benefits the business, it benefits the workers, it is growth for the economy going forward, but we will definitely have to have policies to help cover the ground we lost and push us forward. I'll stop there for a minute.
So that's really interesting, because one of the things we've seen is huge numbers of people. Not only did we have a spike in unemployment, but we had huge numbers of people leave the labor force. That doesn't get counted in the unemployment statistics.
That's right.
People that are just home wishing things could be better. And so how do you think, I'm just curious, just picking up on what you just said there about wage dynamics, how are you thinking about the fact that there could be lots and lots of people sort of re-entering the labor force as employment conditions improve? That's not going to change the unemployment rate per se, but it is going to increase the workforce participation rate. How do you think that's going to play through in this wage story that you're laying out for us, where wage pressures are going to maybe make it harder for small and medium-sized businesses to grow? That seems like that might be something that dampens that concern a little bit, or how do you see it?
It is a good news and a bad news story. Deeper labor participation is important for business growth, but it is also important for the kinds of things that I look at regularly, and that is social opportunity. The deeper we go into the labor pool, the more opportunities there are for people who have been disengaged from the workforce to become engaged. That is a very good thing. But that will, in fact, put additional pressure on this notion of wage progression, because the deeper we go into the labor pool, the more we are getting into people with lesser skills, lesser abilities. So it's a good news and a bad news story. We want to see broader and deeper labor participation rates. We want people back in the labor pool, but at the same time, which really supports my point, David, that there must be deep intentionality around something like wage progression.
Yeah, I see what you mean. You know, in terms of this spectrum between Main Street and Sand Hill Road, to lean on this this thing Olaf's given us even further, we've sort of started in the middle with you, Sandra, because of your focus sort of on growth capital. And you're talking about PPP being very successful for the portfolio companies you're looking at. You're probably looking at the top end of the spectrum in terms of the size of company that's applying for PPP and the kind of sophistication that they have in terms of internal controls and banking relationships and stuff like that. Before I turn and look at the extremes of this spectrum, I want to key back, because I'm seeing some questions come in the Q&A window here that I want to address. I want to touch on your role as Chief Impact Officer, because we're seeing questions in the Q&A window about the importance of ESG considerations in entrepreneurship and gender considerations in entrepreneurship. And I'm wondering if you can just reflect on that from the vantage point of your role as Chief Impact Officer. What are you seeing in terms of how are ESG considerations that would have normally been front and center in some of your decisions? Are those being changed as a result of the pandemic and what we're seeing, or maybe you're emphasizing some things over others? Can you comment briefly on that?
Sure. So I'm going to answer in two tranches. I'm going to answer in my role here as a Chief Investment Officer at Advantage Capital, where we are very focused, very laser focused on what our ESG outcome is, what we seek to achieve. And that is job creation, high wage, high benefit, rapid growth, job creation. That's the outcome that I am constantly monitoring. And then looking beneath that to see, and then what changes when you drive investment capital to achieve that impact outcome, what happens? And so the pandemic and the havoc wreaked by it has just sharpened our focus around that piece of work, and it will not change. How we raise the capital and what the return, that could be impacted by some of the other things that I've talked about already, and by what my panelists will share with you around how fast we can start to recover. Now, let me step outside of that role and say, as Chief Impact Officer, I also spend time looking at the ESG landscape. And what I am reading and picking up is that there's an intensified look at those outcomes, environment, social governance, intense from the investor's perspective. But what I find most interesting is that it's becoming more focused. One of the great challenges, I think, in impact investing has been that we have literally, in the investment community, been all over the map. You identify it, and somebody had a way to call it an impact that we were seeking. And now I do believe that the pandemic has caused us to draw, in this country, to draw in and focus more on really what is it that we seek to achieve. We cannot rehang the moon every other day. We really do have to get some impacts that are real, that are measurable, and that we can have a flow-through thread where we see the result.
Yeah, that makes a lot of sense. Thank you for that. Let me open it up to our other panelists, Yael and Steve, and just picking up on this thread that Sandra's laid out for us. How, if you think about venture capital more generally, our friend Paul Gompers has a paper with several colleagues called, I guess, venture capital's Me Too moment. And we're seeing a lot of changes inside venture capital organizations in terms of their composition and how that's impacting, in terms of how that's impacting how they're investing. I want to get your perspectives on this, and maybe I can get you to comment on this. Do you feel like we're seeing the kind of changes that we need in the composition of the investor base in order to continue to promote some of these ESG objectives and just sort of the gender parity and racial parity objectives that are implicit in that?
There's a lot to unpack there, and I think this is an ongoing process, right? One of the interesting things about Paul's work, less about the Me Too hashtag, but putting that aside, one of the interesting things that Paul finds in that paper really is that the Ellen Pao trial led to more hiring of female partners at venture firms, and that the investment in female-led businesses went up as a result. But the really interesting piece of it is that it did not go up for the male partners. It goes the investments are coming from female investors in female-led businesses, and I think there is this is maybe just a start in the direction, but there is a discussion to be had here around if we want to see more investment in, minority-led startups, in female-led startups. Is part of that about having, and part of the reason we haven't seen it as much, the fact that we don't have as many investors that come from communities of color or that come from that come from other, the other gender, and, how much of this can we help accelerate by just sort of recognizing that, even if you sort of take bias out of the discussion, just the fact that sometimes, the types of businesses that women are leading, the types of businesses that underrepresented minorities are leading, are hitting target markets that your average male white investor just doesn't understand enough to really see the opportunities. And, will we see with more of this movement towards bringing in partners into the investment partnerships that come from different backgrounds? Will we now see that trickle over into investment into founders that come from different backgrounds? And I think as you talk to many of the LPs, you're starting to see a push in that direction where LPs are starting to think about this as well. What does it mean to have an all white male partnership versus to have a little bit of diversity in that partnership, and what it means in terms of the potential for not missing out on opportunities, for having completely different networks to source deal flow from having completely different target markets to think about and to try and understand. So I think I think we need more of it. It's an ongoing process, but I think at least it looks like that process has begun, and the more conversation we have about it, hopefully the more it accelerates.
So, Yael, you're bringing up a really interesting point, and I think this is a point that's been too often overlooked in discussions about gender and racial parity inside investment organizations. And it's, we often hear about, the returns to investing in Black entrepreneurs are high. The returns to investing in female entrepreneurs are really high, and that should draw capital to them. And I think what gets lost in that is the fact that a Black investment committee probably has a better read on the value proposition of a Black entrepreneur than a white investment committee. And so their due diligence costs are lower. They're a better match. And so I think thinking through these processes in terms of thinking about the match between the investor and the entrepreneur, is going to change the way we think about the way these dynamics play out over time. I mean,
I think we see that even with just ethnicity in general, right? We've seen lots of research on, people of certain ethnic background investing in other people from their ethnic background, and how there's lower search costs, there's lower information costs, there's more soft information. There's, so there are a lot of features like this, I think, that do play in exactly as you're suggesting.
Yeah, I want to try to cover this entire spectrum, running all the way from the smallest businesses, all the way to VC. But since we're on the point of VC, I want to stay here for a minute and try to pick up some more of these issues. Steve, I want to hear from you, and I'm particularly interested in hearing your reactions to some of what Olaf was talking to us about in terms of the it seems like VC dollars sort of hardly paused during this pandemic. And can you help unpack that for us a bit? I mean, are we just seeing dollars following on previous investments to support companies that already had an A round or a B round? Or, what are you seeing in terms of how capital is getting allocated as in the wake of the pandemic?
I mean, I think you're seeing all of the above. And so there was in Q2, there was sort of a stop on new deals. And so you saw very few. It started coming back in Q3. And actually, over the course of the year, the number of first-time VC investments in deals was about what it was in 2019. And that's extraordinary, because if you look at the other recessions we've had, the investing in early stage deals like dropped off the table. And they were kind of, they were, again, down in Q2 and a little Q3, but the end of the year, they were about the same. And then in terms of their existing companies, I did a survey with Ilya Strabalov, Will Gornal, and Paul Gompers over the summer of venture capital firms. And we asked them, A, were they going to invest in new deals? And they said yes, which they turned out to be telling the truth. And we also asked them what was happening with their portfolios. And this was in July when there was still massive uncertainty, and they were pretty sanguine. It was shocking. 10% of their companies were really hurt. 40% were kind of, sick, but okay. And 50% were doing just fine, if not, really doing well. And so we concluded, venture capitalists will do fine. And then, of course, the equity markets took off in Q3 and Q4. And this is a golden age of venture capital. It's like stunning. The returns to VCs, I don't know if it's widely understood at this point, are the best they've been since the 96, 97 vintages. It's like, with the dot-com boom. And there are going to be a lot of people, putting up like awesome numbers when Q4 and Q1 21 come out.
So I want to dig deeper into this, Steve, because you're comparing what's happened in the pandemic and the pandemic-induced recession or related recession with previous recessions, but this recession is very different.
Yes,
and there were a ton of really interesting opportunities that were brought to the fore by the adjustments that we had to make in life in order to manage the pandemic.
The world
right?
went digital, and healthcare, was a hero, right? So
yeah,
those are the two things VCs
invested. Was the savior of humanity, and and we all got locked in our rooms watching Netflix all day. No, but in all seriousness, I feel like part of what the pandemic did that makes it very different from other recessions is it accelerated it accelerated changes that were already happening. It brought them forward in time, and that created excess demand for capital that might have played out over a number of years. How much of what you were seeing in Q3 and was the inevitable response to that, or do you think that it was capital that was being deployed kind of beyond what I'll call pandemic shockwave investment?
You never know, right? It's very hard to predict while you're in it, because 1998 investments were great, right? In the middle of the dot-com boom. 99 and 2000 investments not. So, are we in 1997, 98 now, or are we in 99, 2000? And my sense is Q3, and Q4, the investments were probably, good. And now, you get a sense there's a bit of a, once people have seen these returns, people have this money, and there's a bit of a frenzy. I think it was the Journal today had an article about deal frenzy on the venture side. And
I lost your audio for a second, Steve.
Oh, sorry.
Oh, there you go. You came back. It may have been
that deal. That's odd. I'm in my office. It should be good internet. There's an article in the Wall Street Journal about deal frenzy today. So in Silicon Valley. So has it gone, too far? We'll see. We don't know.
Well, that's exactly the question I was going to follow up with, because if you think about what happened in the late 1990s, we had, some people might argue overinvestment, that, but a lot of that overinvestment laid the foundations for the next wave of internet use that we had. And, all that dark fiber that got laid in 2000, 2001 gave us, streaming video and, everything else. Are we in that same world now? And Yael, Sandra, please jump in here as well. This is actually not an interview.
I'll just make an observation as well, which is that the kinds of companies that venture is investing in to a great extent are the kinds of companies where business can continue remotely, where the fact that we've moved to this digital world where we're on Zoom and people are working from home and teams have to kind of kind of figure out how to coordinate remotely and make things work. You can't do that with a lot of the small Main Street businesses right? But you can do that with a lot of the technology businesses and more generally with innovation-driven businesses. And on top of that, a lot of those goods and services are sold digitally as well. They transition to the internet, which means that in a very real way, while there's sort of a pause while we figure out what's going on, as you progressed further into the pandemic, there's sort of this realization that actually everything can sort of go on roughly as, in a new normal, but those businesses can.
For some people, not everyone.
Not all of them, which is why, you're going to see that 10% or the 20% that are not going to manage. But I think for a large part, there are investment opportunities out there in many ways for venture that, aren't nearly as affected by what's going on here. And that a lot of the recession piece is coming with the things that do actually involve, it's restaurants, it's small businesses where people actually do have to show up in person, and where they can't sort of substitute with a lot of the digital aspects that many technology companies have.
Yeah, it's interesting to think about how Main Street is accessible to the whole world through the digital sort of digital sales channels. You can visit any Main Street you want, and that certainly changes this dichotomy and makes it much richer.
Well, but I was saying it's for the consumer side. This is it's the well-off people who do well on this and can access it, and the people at the lower end have it's harder. I think again, some of the stimulus money really helped there to keep people with money, and it'll be very interesting to see going forward what happens on employment. Although the thing that people maybe forget.
Steve, my audio on you is dropping out again. I may be the only.
Is it me or is it you? Can you hear me? Sandra, can you hear me?
I can hear Steve.
Good.
David, your audio dropped out a little.
It's on me. Sorry, guys. I'll be quiet.
I can hear both of you, but David, you are dropping in and out.
Okay. I'm at the University of Chicago. We have good internet. So I was saying in Q4 2019, the employment numbers were terrific, and in fact the income inequality numbers were good too. The over the sort of 3-year period or previous 4 years, the lower income people actually did pretty well, and everybody did well because the economy was good, but the income inequality numbers were getting better. Employment was terrific, and I won't channel our former president on that, but that there's some truth to the fact that things were good, and then the pandemic just completely crushed everything, and particularly on the lower end. And so now the question is, how do you get out of it? And we'll see. And it has gone more digital, and where are jobs going to come from? And we don't know. I'm I tend to like markets and trust them, so I'm cautiously optimistic, but we'll see.
Yeah. Sandra, right?
So both Steve and Yael have said all that I would say, but I really, in facing forward as an investor and talking right now with potential LPs about ways to target investing to get the outcomes that we seek, more jobs in places where real people can work them. Because you know that these or mid-level companies rather, are the ones that drive job creation from the ground up. So we need both things. We need the innovation that VC capitalists can run to right now, and there are lots of it, but we also need the investment from the bottom up in order to get to balance and reasonable healthiness in our economy. So in looking forward, I think the most important thing is focus with intentionality around these challenges. That's what I think is the great benefit of this Me Too moment that exists, not just in looking at what's happening with investors, but also looking at how investors are behaving in relationship to what they want from the rest to happen in the rest of the economy.
That's a really great point, Sandra. We've got a really interesting question from Bobby Franklin at NVCA, but before I put his question out to everyone, I want to stay on this point that you've raised, Sandra, because first of all, I think it's incredibly important that we focus this conversation on looking forward over the next 18 months rather than looking in the rearview mirror. But you know, we talk about the world changing and it becoming much more acceptable for, you know, work from home is taking off. And we talk about, you've stressed, Sandra, the importance of wages and of creating good jobs. And in lurking in the background is this discussion about equity and underserved, underappreciated communities. Changes in real estate really have some knock-on effects here. If you think about the fact that pushing everyone out of the workplace and working from home, that's changed the demand for household amenities. It's easy to work from home if you've got a home office with high-speed internet. Yes. It's not as easy to work from home if you don't have high-speed internet, don't have a home office, you got to manage childcare, things like that. So I think there's a real possibility that if we don't act with intentionality here, that we're going to exacerbate many of the underlying trends just because we're relying. So we'll be relying that much more on household amenities where we already know that there are big disparities. I'm wondering, you know, how are you thinking about that? And
so David, let me just say one thing.
Just going forward from here.
Let me just say one thing quickly, and I'll get out the way for my co-panelists on this point. See, I'm with Steve. I believe in the market.
Yeah,
I really do. When I came to this work from the not-for-profit world, when I decided that the only way that the changes that I really cared about, the social and economic gaps that I wanted to see closed, when I came to the realization they would only be closed by private sector investment, appropriately driven. So I believe in the market. And that's where I think the enormity of opportunity is, and why I dwell on intentionality in both policy and as a practitioner. I ride my own partners. It's not hard because they agree with me on intentionality, because we can figure out, the market can figure out and invest in how to make certain that we create accessible pockets of internet of high quality for the communities that can't get it like you and I get it.
And I think you're going to see, I mean, certainly everything I see, there's a lot of demand from investors to give money to people who are going to invest in those areas where there's women or underrepresented groups. And that's going to be a really good experiment to run because we're going to see, are the returns there or not? And I sure hope they are. Because that'd be a really good outcome. But if they're not, we'll learn something too. And so it's an experiment that is about to be run because there's a lot of demand for that, and it'll be very interesting to see what happens.
Yeah, I agree. You're not going to get a lot of pushback from me, by the way, Sandra, on the markets being the best solution available here. I'm not going to fight you on that one. I've got a ton of questions coming in through the Q&A window, and they're great questions. And so I want to try to give voice to all of them. But I'm probably going to take them out of order because I'm trying to blend the themes together. Michael Chow is asking about Olaf's chart showing the business closures by race of owner and how striking that was. We saw a much bigger drop in the Black community than in the white community. And so how do you think going forward about how we level the playing field with respect to access to government capital, other forms of support? And I guess, Yael, there's probably a role for innovation and fintech and things like that to play in this. And so I want to hear from everybody.
Yeah, I mean, I think, one of the things to recognize is that the way we distributed PPP had big effects on who got access and who didn't. The fact that we went through the banks, the fact that for the banks, it was easiest to effectively distribute this money to companies with which they had pre-existing relationships where they sort of understood what they were dealing with. And the fact that, I think there are probably more minority-owned businesses that, just sort of lacked that pre-existing relationship banking with the banks that had, the most PPP money to distribute. And that's part of what we're seeing playing out. And until there were some structural changes in the PPP, that's sort of how it was playing out in the field. But I think that means that we have to start thinking about, what does, how do these funds, whether it's, another injection of capital similar to the PPP, or how we think about SBA backed loans and so forth, how do we distribute this, and what can we be doing in terms of design of the mechanisms to make sure that we are actually being intentional about things and that we are being fair about things? And I think there's a little too often we sort of just point at the infrastructure that we have and say, we'll just use this, and, ignore the fact that a lot of what has been, built up, not necessarily intentionally over time, but just the way it's evolved turns into systems that, give access to particular groups and deny access to others. And that, I think this just sort of brings back to the intentionality piece.
Let me give a quick example. So the banking partner with that we work most closely with for our portfolio companies has given us some feedback. And what they've told us is that the second round of PPP did a much better job addressing the smaller guys and gals in business. What did they do? And consequently, did a much better job with minorities and the underserved populations. What did they do? They turned to 1099s as opposed to some of the financials that were required in the first round. What else did they do? People were able to apply for themselves. And something so simple as being able to stop and start in the application process was built into the system. And there were other things. They started using social security numbers instead of EINs, which a lot of sole proprietors didn't have EINs. Now, right. So there are now we've got really hard data on how much that can change and how it can drive the outcome that we want deeper to get the PPP resources, stabilizing resources to the companies that need them most. But like everything in life, it's a series of trade-offs, because that also opens up the door for potential for more fraud.
Yeah, that's right.
And you ask our banking partner and they say, we've got our eyes closed, Sandy, and our fingers crossed that 2 years from now, we're not getting audited and all of us and our children are being sent to jail. So it's a constant balancing act that has to happen even with intentionality. And I think sharing information in forums like this really helps. So people understand it is not always a binary choice.
To exactly this point about the travails of extending these PPP loans to very, very small businesses, I think it's important to bear in mind that we hear about there being 30 million small businesses in the U.S. And the number that people forget about when they hear that is that about 24 million of those small businesses have 0 employees. And so that means that for about 5/6 of the population that you're intending to treat with PPP, a direct deposit into a bank account is a perfect substitute for the economic impact of it, right? A perfect substitute. And so I think we've spent, I'm not trying to sound overly critical of PPP, because I understand that a lot of it was developed on the fly in the heat of the moment, and we did the best we could with the tools that we had. But I think that I think that a lot of the problems that you're speaking to in that comment would have naturally gone away if we'd had a heightened appreciation for just how much of small business activity is solo entrepreneur activity. And in that world, you can reach that audience much more easily and much more directly by cutting out the banks as the middleman and just going straight into the household bank account, as we have with the stimulus checks that people receive. So we know how to do that. We know how to make a direct deposit into a bank account, and we could have done more of that. Anyway, I think too often that fact gets overlooked. Let me turn back to some questions that are coming into the Q&A panel here. And I want to go back to go back to the subject of VCs, because a lot of the discussions that we've been having here, a lot of the changes in behavior that we're seeing in VCs are at some level coming from LPs pushing them to behave differently. And so Bobby Franklin has an interesting question here, that at the NVCA, they're observing that the sort of investment tourists that step into venture capital over the last few years seems to be going down. And I'm curious to hear, sort of both from the academic perspective and from the practitioner perspective, are you seeing kind of a change, are you seeing changes on that front? And what do you think trends are going to look like going forward in terms of there being a more heterogeneity in the types of people who are trying to get into venture? This is something that we've seen in past spikes where, when the market goes up, it pulls in a lot of new money into venture capital, some of which is not terribly well suited to ride out the bumps along the way. What are you guys seeing there, and how do you think this is going to play out over the next 18 months, 24 months, as invariably some things start to shake out?
So, I think part of what Bobby's pointing at, and I know his question also was asking a little bit about, how do we think about this as the private versus public markets debate, and some of what we've been seeing with the changes and who goes public. I think there is a definite shift that has happened in terms of what kinds of companies really can be supported by the public market, want to be supported by the public market, are going to be accepted by retail investors, which has led to an explosion of private capital investing in companies. And I'm not saying it's bad or it's good. I think we don't, necessarily, I don't know that we have the research to necessarily stand behind any of it. But I do think that, when you start talking about companies raising the kind of money they used to raise on public markets in private markets, that does mean that it's going to require a different kind of investor to step in, and that we're going to see new classes of investors who are stepping in to fill those gaps. I think even before that shift happened, the retail investor was falling off on Wall Street, right? We were into big institutions. Maybe it's not too surprising that now those institutions are doing this just without the burdens and the scrutiny of the public market. I don't know that we're necessarily going to see. I think some of these groups that we thought were tourists are not tourists. This is a real new investment class. Steve and Sandra may have different thoughts on that.
I think what Bobby is referring to is first-time funds in the NVCA database are down, and the investment is up in general. So it's the existing folks who are there raising the money, and I think there's some truth to that on the institutional side. Let me just go back though. I'm going to go back to 2010 to 2015 and then come to today. 2010 to 2015. Actually, the money going to venture was quite low. And when people asked me, where should I allocate my money, which asset class, I said, I would overweight venture. And, occasionally I'm right about predictions. That one I was very right. And now, the amount of money in ventures has flowed in. More is going to flow in this year because the returns are awesome. I think you will see more tourists because everybody wants into venture, and this is what happened in 99 and 2000. You also see, and I'm guessing this is not in the NVCA data, there are a lot of sort of smaller funds that are not institutional that are out there investing. And I've got I probably have 5 or 10 former students who have such funds, and that's, you know, so you got to multiply that by a lot, and some of those are going to do well, and then they're going to become institutional funds, and some of them are you know, a couple of those are women founders. So you'll, you know, which is the group, you know, that the Gompers Want paper wrote about. So I think you're going to see, you know, money coming in. You're going to see it go to different groups. The bigger existing groups get more of it, but you know, there'll be things happening, I think.
Sandra, did you want to add?
No, I won't, other than to say I want both things to be true.
Yeah.
You know,
Yeah.
so David, one thing I will add is that I think to the extent that we do want to see more of these new investment groups, to think to the extent that we don't want this market to become merely large chunks of growth capital, and that we want more seed funds and so forth, there are a lot, you know, going back to the intentionality point, there's a lot of things we do actually have to start thinking about. And that's, you know, as we start thinking about implementing, you know, potentially new tax changes and so forth, there are going to be a lot of things that are potentially going to affect the ability of particularly the smaller funds to be financially viable. And you know, I think a part of the intentionality piece is understanding that when we make changes that we think are meant to address, you know, societal ills at the top end, we're going to have to start thinking very carefully about what the implications are at the bottom end, and how that is going to affect the smaller funds that really serve the middle of America and that serve the minority communities. And you know, I think we actually want, you know, I don't think, no, we want tourists, but we definitely want more of that. We want more experiments, and we want more first-time funds. So
you want new travelers.
Yeah,
exactly.
that's right.
New travelers. I like that. Exactly.
And that is what I so facetiously meant when I said we want both things to happen.
Yeah, yeah. Well, so this is a perfect lead into to a question here by Vicki Gibbs at UNC. How can new funds coming into VC, these new travelers, if you will, or innovators, how can they help address disparities in how venture capital is dispersed to underrepresented groups? And what advice would you have to investors who are considering going into that space now?
Sandra, were you about to say something?
No, go ahead. Go ahead. That is a very tough question, but go ahead. Yeah, you go first.
I was going to say, I mean, I think, you know, if you are interested in this, I think there's opportunity to be found. It's opportunity to be found outside of the traditional hubs and in areas that I think just haven't had people looking at them and haven't had people scrutinizing them. It's going to need support, and we probably should be trying to generate more of those companies to begin with in those areas. But I think, you know, the groups that, you know, particularly the communities that are outside of Silicon Valley, they're outside of New York, LA, et cetera, who are, you know, which is I think where there's a lot of opportunity for precisely, you know, these kinds of ventures to start up. They are, you know, that's going to be places where you want the smaller funds and the newer funds. That's where these funds need to be playing. And I think if you're, you know, you're just another fund coming into Silicon Valley, you know, that's, you know, that can be a very different story. But if you want to be intentional about things, you need to be looking at other types of communities, and you need to be looking outside the hubs. And I do think that the pandemic and the digital transformation is going to help that a lot. I think it's brought down a lot of the barriers, you know, that people were sort of like, I don't want to get on a plane, I'm not going to look at these cities in middle America. I do think that now there's a greater willingness and a greater ability for people to sit on the coasts and say, yes, but I can still invest in the Midwest. I can still invest in the South, and so forth. So it's going to be interesting.
So the reason I say this is such a tough question is I agree with everything that you just said, Gail, but the elephant that is in the room that hasn't been stated is that there also has to be some adjustment of expectations on return.
Yes. Yeah, the returns are going to be different, right? But
that there has to be some new appreciation of the pricing of risk.
Yeah. So this is exactly what I was going to say, Sandra. We talked about the returns being different. Everybody focuses on returns, but the other half of returns is risk. And so, I mean, you know, we may be in a situation where we have a more favorable risk return trade-off, especially in the context of a broader portfolio, even if the headline return number is, let's just go ahead and say it, lower.
But I'm seeing more and more of this where I have former students coming to me or raising funds where the premise is not I'm looking for billion-dollar exits. The premise is I get into companies that are going to require much less capital in order to reach a $50 million exit. And I can make great returns off of that. And I can build companies that will employ many, many people and that will provide fantastic exits for the founders, meaningful exits for the founders. And they don't have to be multi-billion-dollar companies, right? They are companies that are providing real goods, real services where, you know, you start thinking about going in you start thinking about how I deploy in total 2 to 5 million, not 20 to 500 million, right? And that's a different game to be playing in. But I think more and more of the smaller funds are realizing that there is an opportunity to make good returns there with a very different risk reward kind of viewpoint than what you're thinking about when you're investing a $1 billion fund. It's sitting out of the Bay Area.
Go ahead, Steve.
No, that's the question I said earlier. LPs are interested in funding these kinds of investments now, I think, more than they used to be. And some will call them impact, some won't. But then you're going to run that experiment and see if the returns are there. And that's the big question. And let's hope they're there. We'll see.
Steve, you'll run the experiment and see if the returns are there. And if the returns are not there, if there is the appetite to stay in the space for less returns, or what concessions are LPs willing to make in exchange for returns? I mean, this is a big area.
That's a big question too. And that's the private sector people, I don't think are going to have an appetite for it, and whether the public investors do or not, that's it's a political issue, I think, but that's,
So LPs have to be willing to put their money behind these things as well. And I think that is one of that's one of the issues is just sort of, are the LPs going to be willing to experiment? And how do you handle the fact that in many cases, the big institutional LPs want to write much, much bigger checks. And if you're talking about raising a $50 million fund, that if they can't put 20 million in, that's a problem. Where is that money going to come from? But, I think, that's an area that we're again going to need some experimentation with.
So I'm mindful of our time, and we've only got a little over 5 minutes before we need to conclude. And before I do that, though, I just want to build on this point that you've been making, Yael, and implicit in what you've been saying, is that when we talk about diversity, especially now with the out-migration from cities that we're seeing in the midst of the pandemic, geographic diversity in investment is an important issue here, and sort of geographic changes in the locus of entrepreneurial activity, I think, is something that's going to be important going forward. And I just want to give just a few brief minutes to that before we wrap up. How do you guys see? I mean, I guess it's sort of implicit in some of what you've already said in terms of smaller funds being able to operate creatively in some of these smaller markets. But what do you see looking ahead in terms of new locuses of entrepreneurial activity, and how is this going to change sort of the broader dynamics that we're used to thinking about in this market?
There's certainly, and Sandy is probably in the position to talk more about this, but at least the VCs I talk to, they're more comfortable doing deals in non-standard geographies, and they all, particularly with Zoom, they can do a lot of stuff.
How much of it is just us getting comfortable with Zoom? We can suddenly
it's a big chunk, and also I think talent is distributed more broadly than just a few places, and I think that's going to be a reality.
So it has been our business model and our success foundation that we're willing to go where the capital won't, and we will continue that. And we do see that particularly in the smaller firms. They're starting to run to the Midwest. They're starting to run to the upper Midwest. As we speak, I'm sitting right here in St. Louis, and St. Louis has become quite a little hotbed for startups. And we are beginning to see through a 10-year effort, companies, startups moving here because they will get the broad base of support that they need and capital to really grow. So I think this world is changing dramatically. And I think that this pandemic, it's one of the upsides of it. We've all had to figure out how to invest in something that maybe you haven't seen other than on television. But we are figuring it out. You tell us, Steve, we're doing better than we ever have. So we figured it out. We are in a period of big transition. I want it to happen. However, I love keeping our competitive advantage because we've been doing it a long time. We are all across the country. So come join us.
Yeah, I mean, I think, I'd point at Chicago and a lot of the efforts that Steve's been engaged with as well in the last 10 years as proof that you can build an ecosystem, right? That you really can take ecosystems and accelerate them and put that kink in the curve that really makes a difference. And we're putting a lot of the same sorts of efforts that Chicago put in 5-10 years ago here in Houston with the same sort of idea in mind. And there are many cities in in the Midwest and that have tremendously diverse populations where there's tremendous talent that's just hidden and that doesn't even realize that these are opportunities for them. And I think that stepping back for us to think about things around, entrepreneurship education and how we do that at universities, not just at, the MITs and Stanfords of the world, but at the HBCUs and the MSIs and all of our big state institutions, and thinking about how we support more of the translational research that takes the basic science out of the universities, tremendous research universities in the middle of the country, where we're really not utilizing much of what we fund with federal research dollars, but really could. And things, I think there are investments we can make that will be transformational as well in creating those companies that capital like Sandra's and capital from the coast is going to come in and absolutely fund.
Let me say one more thing very quickly. We also have been pushing into investing in rural, ex-urban and rural areas in the country. And I think that as the pandemic has taught us that we can live in less congested urban areas and we can thrive in suburban, ex-urban and rural areas, you're going to see more capital being driven into those geographies. And when the capital goes there, you see the result.
Everything else follows, yeah. So we're almost at time, and I need to be mindful of our time here. So I'm going to just throw out one final question, and this is going to be a lightning round speed question. I'm going to put each of you on the spot. But a big part of what we're trying to do at the Frontiers of Entrepreneurship Conference is set the stage for future research. And so I want to close by just you can just throw out a one-word answer if you want, but what are the topics or projects where you think we need new research, and what questions should we be asking now in order to have answers at the ready, looking ahead? It can be high-level topic, it can be question on your mind. Where should we be directing our research efforts?
I'll start that. So I want to go to something Sandra said about measuring, how she measures impact. And I love that she said job creation, because you can measure that.
Yeah.
And I think you want to figure out, how do you measure impact and which impact is most value accretive if you're thinking about your LPs. And my guess is job creation is very correlated with creating value. So that's a good one, but it'd be nice to know. And then other pieces of ESG that people care about, whether it's diverse workforces or environmental, are those, how do you measure it? Yeah, and then what's correlated with value? Because if you can find, those impacts that are socially desirable and value accretive, that's what you want.
Yeah, great. Yeah, Sandra?
I'll go. I want to understand, get some research done on what concessions will actually stand out. What is it that LPs are willing to concede on in exchange for what?
I see. And that ties closely to what Steve's saying.
That's right.
Yeah, it's
Let's,
different.
let's understand that.
Yeah, it's related. Yeah.
I think from my perspective, I'd also like to see more research around the actual cost benefit analysis around the kinds of interventions that we use to build ecosystems and where is it best for us to be putting our dollars, not just what works, but what works best and how things work in concert.
Awesome. What a wonderful panel. Thank you all. Thank you, Sandra. Thank you, Steve. Thank you, Yael. Really enjoyed this conversation. And I want to thank everyone on the call for your attention and for your questions. We're going to take a quick break now, but we hope that you'll join us back here at 12:40 Eastern time. So in 20 minutes time from now for our next session, which is entitled Creating Ecosystems Where Diverse Groups of Entrepreneurs Thrive. Thank you very much.